This will show you what a weekly, I think it's probably a monthly. Every single one of these lines, whether it be a red one or a green one, represents 1 month's worth of trading or somewhere in that range, I believe. That's actually about 2 weeks worth of trading for I can tell here. So we go all the way back here. I'm going to see where my cursor is at. This, because of its 2 weeks worth of trading, it's not going to give you the exact date, but November 25th, 2008, right over here, hard to see on your guys' screen, but that day was when the Federal Reserve announced quantitative easing. So that day is where everything goes above this line definitively and stays above that line, this yellow line that I drew. I drew that yellow line right on the price point of this security the day the Fed announced quantitative easing. When they announced that, meaning the Fed was going to take, because of the crash, there was not a lot of capital going into the markets, not a lot of people wanting to lend. They were scared to lend because of the foreclosures and all that. Fed says, well, we're going to give you so much liquidity, you can't have a choice but to lend. So then when they announced it, a bunch of money got poured into the mortgage-backed securities, and then the Fed started in it in 2009, which is right about here, and they stayed in it. And they stayed in it.
Wait, Aaron, what do you mean by the Feds got in it?
The Federal Reserve itself had taken money from the U.S. Treasury, filtered from the Treasury to the Federal Reserve, and started buying into different securities across the globe. Mainly it was T-bills, Treasuries, and to the mortgage-backed securities, or the MBS as they're referred to. And then also they started doing some corporate bonds. They were investing in our economy. And
now,
so
how common is that? Are they typically
completely uncommon? Has not happened before that I have any charts of other than this window of time.
Okay, I didn't think so, but I just wanted to point that out. I mean,
yes, so that's not something that happens at all. And so what you have here is, well, the thing is did the Fed have the money to put in there? Did they have $9 trillion to put in there to begin with? Not really. So what they had to do is they had to create it. It was created by the U.S. Treasury, and then it filtered out through the Fed. And the Fed is actually a private institution, which is the bank of the banks, right? So the banks got to go somewhere to put their money and do their trading and exchanging. They go to the Federal Reserve. So the Federal Reserve has multiple different locations across the United States, and then those who run the Federal Reserve, like St. Louis or New York, or I think there's the Fed of Atlanta, and all these different ones. What they do is they will come together and have their governor's meeting, and so that's how you get monetary policy being put together. Well, with all this capital being invested into it, the interest rates started to drop because there's more and more capital, supply and demand. Not a lot of demand at the moment. People were scared to buy, scared to get into any sort of loan. A lot of people didn't qualify because they had all these foreclosures. They had problems with the credit, all that stuff that happened. But you had tons of money going in, so the interest rates kept dropping. And because that money kept flowing in, we saw this long period of time of extremely low interest rates. So you get to 2017, and in 2017 is when the Fed starts saying, we're going to do quantitative tightening, means we're going to put less in. Now they have all this money that's been put in, and every time they get a payment or a return on interest, they just reinvest that and reinvest that. So it's just a snowballing growth of capital going in there. They said, we're going to stop doing the reinvestment. Well, it freaked out the market. They called it at this point, called a taper tantrum. And so the whole market freaked out. They started selling their shares off, getting out of the mortgage-backed securities, causing some disruption in the markets. The Fed back in 2018 or late 2018, early 2019 said, okay, we'll go back in. And then you get to the point of the pandemic. Now, you get to from January 1 of 2009 to the end of March 2010, the Fed had invested $1.25 trillion into this to stimulate the economy. And you go all the way forward to 2020, you have March of 2020. On March 20th, they decided to do some heavy reinvestment because you had massive sell-off at that time because of the pandemic. The pandemic caused massive disruption with stocks dropping significantly. And when you think about banks, they don't take your deposits and stick it in the vault, right? They take your deposits and they put it to work in the market. Well, a lot of that will go into stocks. And when it goes into stocks, there's a good solid chance a lot of it's on margin. And when those margin calls come in, they've got to pay those margin calls. How do they pay those margin calls? They got to sell tangible assets. Some of those assets were mortgage-backed securities. There's other things that were going on in the background too. That's just one little sliver of it. But because that, a lot of sell-off in the mortgage-backed securities pools, causing the rates to spike quickly. In fact, during that first part of March up until March 20th, I couldn't lock a loan. I would sit there with 50 loans ready to lock. and we wouldn't have pricing up. And I would just all day long just recycle until I saw pricing up. And I would immediately instant message 4 staff members, and we would all log in together and just be locking. So my licensed staff members that can lock in certain states would help me lock, right? I had people corporate helping me. So I was the only guy who had a bunch of loans already locked. So we're locking 50 at a time. And then all of a sudden the window would close and we couldn't lock anymore. It's just so we can keep closing deals. My competitors that I talked to on the regular at that time, they just like, hey, we just shut down business, can't do anything anyway. I took advantage and stayed at it. Little windows, 10 minutes here, 20 minutes there. I could probably lock only once a day, but we would do tons of them at once. And we kept going. Now, what the Fed did from March 20th to March 30th, they invested another $1 trillion in 10 days to get this market back on track. And that was represented just a little blip right here is all you can tell. But you get all the way up until the end of October 2021, they announced the full-on quantitative tightening. And that's where we see the face fell off of this whole thing, dropped off a cliff, and we have interest rates tripled practically. Now, what's key here and what I'm showing is this yellow line that I established nobody was talking about it. Nobody ever went back and talked about what happened in the past. Nobody talked about the price of the security back in 2008 when the Fed announced quantitative easing. So I went back and I looked, and that's where I established this yellow line was the day they announced it. So fast forward to now, you've got where we broke below that line back in September last year. Of course, climb back above it. Traders worked their way back to what's called the 200-day moving average. We got all these different lines represent a different time frame. This 200-day moving average, 100-day moving average, 50, 35, 20, and 14. So you can see the average of how the security prices out. But every time they hit the 200-day, they would sell off. Every time it hits the 200-day, it'd sell off. There's only 4 days that ever stayed above the 200-day for any definitive amount of time, but it's always selling off when it hits the 200-day moving average. That's a price point that nobody wants to stay above. Everybody sells their position there. Well, interestingly enough, it passed that point on May 24th, actually it was May 25th of this year. The 200-day moving average dropped below the price point established in 2008 when they announced quantitative easing. My belief is this is the point where we have seen the lowest interest rate that we will see for the foreseeable future is really this day, which was, they're all back here. These days belong back before here, but that day right there marks the date that we're not seeing it going lower, in my opinion. So if you scroll forward a ways, you can see that 200-day moving average will continue to drop a bit, maybe even settle out, who knows, but we're going to play in this range. We're right here today, right at this point. We're going to play in this range, probably down to here, driving interest rates for the real estate investor, somewhere probably, I would guess, in the 8s, high 7s, low 8s. It's possible where we reach the double digits. I can't say for certain that that's going to happen, but I believe that that's where we're going. Now, a lot of people are freaking out saying, wow, I can't believe there are markets going there. There are some lenders, no, we're going to get back to a normal market. But most of these guys haven't been in the industry long enough to know what a normal market is. There's a lot of people who have been in the industry less than 10 years. Well, quantitative easing was started in 2009. It was announced in 2008.
If you want to see if infinite banking is for you, you can schedule a quick discovery call, and that link can be found in the show notes below. If you found value in this content, make sure you hit that subscribe button and look for us on all the major social media platforms.
If you want to know how investors use infinite banking to increase their returns and lower their taxes, click here. If you want to see the full podcast episode, click here.